Imagine you're steering a multi-trillion-dollar economy.
Right, which is no small task.
No, exactly. It's basically like navigating this deeply reinforced state-of-the-art submarine, right through a geopolitical hurricane.
Yeah, the waves on the surface are just incredibly violent right now.
We're talking global supply chain disruptions, energy market chaos, the widening conflict in West Asia. It's a lot.
It really is.
So as the captain, do you floor the engines to try and power your way through the storm, or do you cut the engines, hold your depth, and just meticulously check every single valve and pressure gauge on the inside of the ship?
That's the million-dollar question, isn't it?
It is. And today we are looking at the Reserve Bank of India's April 2026 playbook. Specifically, we're doing a deep dive into the April 2026 Monetary and Credit Information Review, Volume XT2, Issue 1.
Which is such a critical document.
Yeah, and what we're seeing is that their decision to kind of wait and watch on the macro level is actually triggering this massive, under-the-radar overhaul of the entire banking system's internal plumbing.
It's a really fascinating duality. And it's exactly why we're dissecting sections I through V of this specific MCIR document today.
Right, and if you're listening to us right now, you are likely staring down the barrel of a high-stakes professional examination.
Exactly. You're a peer, you're an analyst, and you know that simply getting the gist of a central bank policy, it just won't cut it.
No, the examiners are going to dig deep.
They really are. They don't just want to know what the repo rate is, They want you to prove that you understand exactly why the RBI eliminated a specific capital buffer for commercial banks while keeping it for others.
Like the regional rural banks.
Right, exactly. So we're going to unpack the underlying debates, the regulatory logic, and the mechanical realities of these policies.
We want to give you that conversational fluency so you can absolutely crush this material.
So let's dive right into that submarine analogy, starting at the macro level with the 60th Monetary Policy Committee meeting.
Yeah, because the defensive maneuvering here is just intense.
It is. Now, for your exam, you need to lock down the timeline first. The MPC met from April 6th to April 8th, 2026.
Okay, got it.
Governor Shri Sanjay Malhotra announced the statement on April 8th, and then, exactly 14 days later, on April 22, the minutes dropped.
Wait, I want to pause on that. That 14-day gap, that isn't just some administrative lag, right?
No, not at all. And that's a critical exam takeaway. It is a strict statutory requirement mandated under Section 45ZL of the Reserve Bank of India Act, 1934.
Okay, Section 45ZL.
Yes. The actual MPC meeting convenes under Section 45ZB, but the minutes have to be published exactly a fortnight later under 45ZL.
So you absolutely must differentiate those two sections of the Act in your mind.
Completely. The sequence is rigid. April 6 to 8 for the deliberations, April 8 for the announcement, and April 22 for the minutes detailing all the individual member voting.
Okay, so let's look at the numbers that actually came out of that April 8 announcement because they represent the RBI holding its depth, like we said.
Right.
The MPC voted unanimously to keep the policy repo rate totally unchanged at 5.25%.
Unanimous being the key word there.
Yeah. And consequently, the standing deposit facility, the SDF, is pegged at 5.0%, and the marginal standing facility, or MSF, along with the bank rate, remain at 5.50%.
So the stance is officially and honestly rigidly neutral.
Neutral. But here's what you need to understand for the analytical portion of your exam. Why not cut rates?
Yeah, that's what the examiners will ask.
Because before March 2026, the domestic economic dashboard looked phenomenal, right? Buoyant growth, manageable inflation, robust tax collections.
Everything was pointing up.
Yeah, we had the momentum to justify a rate cut to, say, 5.0%, to really turbocharge domestic manufacturing and private investment. So what forced the freeze?
To understand the freeze, you really have to trace the transmission mechanisms of the global shocks that materialized in late March.
Like the West Asia conflict.
Exactly. The West Asia conflict didn't just cause a spike in localized risk premiums. It fundamentally altered the trajectory of global supply chains.
How so?
Well, if you are the RBI, you are looking at several distinct channels of vulnerability. First up is crude oil. India imports roughly 85% of its crude oil requirements.
Right, which is a massive dependency.
Massive. So when geopolitical tensions risk closing key straits or damaging energy infrastructure, the forward markets for Brent crude just spike.
And that instantly threatens to widen India's current account deficit.
Yes, and it imports inflation directly into the domestic economy.
Because, the pump price goes up, which means transportation costs go up, which means the cost of every single vegetable transported across the country goes up. It's this huge compounding effect.
That's exactly it. And speaking of inflation, we should break down the MPC's specific projections because these are hard numbers the exam will test.
Absolutely, lay that out.
Okay, the MPC estimated real GDP growth for the financial year 2025-26 at a very strong 7.6%.
7.6, got it.
However, for the upcoming 2026-27 financial year, they projected a dip down to 6.9%.
Oh, a bit of a slowdown.
Yeah, and crucially, they explicitly noted that the risks to this 6.9% baseline are tilted to the downside.
Meaning it could be even lower.
Right. They are acknowledging the drag effect of weaker global demand for Indian exports and, tighter global financial conditions as capital seeks safe haven assets in the U.S.
Okay, so growth is projected to soften from 7.6 to 6.9%. What about inflation?
For 2026-27, CPI inflation, that's the headline Consumer Price Index, is projected at 4.6%.
4.6%.
But within that aggregate number, core inflation, which strips out the highly volatile food and fuel components, is projected at a much lower 4.4%.
This spread between headline and core inflation, that is the crux of the RBI's wait-and-watch strategy, isn't it?
It really is. Think about what a core inflation rate of 4.4% actually means.
It tells us that the underlying systemic, demand-driven price pressures in the Indian economy are actually quite contained. The engine isn't overheating.
Right. People aren't borrowing so heavily and spending so aggressively that they are driving up the cost of manufactured goods uncontrollably.
So if the core is behaving and growth is projected to slow down to 6.9%, the classic textbook monetary response would be to cut the repo rate to stimulate the economy.
Exactly. And that is exactly the trap the examiners will try to set for you.
Sneaky.
Very. They will present a scenario with slowing growth and contained core inflation and ask why the RBI maintained a neutral stance at 5.25%.
And what's the answer?
The answer lies entirely in the upside risks to the headline inflation number. The RBI is fighting a two-front war on prices that are completely outside of their control.
Right. Global energy volatility, which we just discussed, and domestic weather anomalies, specifically El Niño.
Yes. Let's trace that El Niño risk mechanically, because it's not just weather is bad, prices go up.
Right. It's about the specific weighting of the CPI basket.
Exactly. Cereals, pulses, and spices have a massive weight in the Indian consumer's basket.
So if an El Niño event causes a spatial and temporal deficit in the southwest monsoon, it directly impacts the Kharif crop sowing.
Yes, which leads to lower yields in rice and pulses. And market anticipation of those lower yields causes hoarding and immediate price spikes in the wholesale mandis.
Which filter down to retail CPI within weeks?
Precisely. The central bank cannot print rain, and they can't print crude oil.
Yeah, if they were to cut the repo rate now, injecting more liquidity and cheaper credit into the system, and suddenly crude oil spikes to $120 a barrel.
Or the monsoon fails.
Right. They would find themselves pouring gasoline on an inflationary fire. They'd be forced into a rapid, highly disruptive cycle of rate hikes.
Therefore, the prudent defensive maneuver is the wait-and-watch approach. You hold the repo rate at 5.25%, keep liquidity comfortable but not excessive, and maintain the neutral stance.
So you have the flexibility to pivot in either direction based on how the data actually materializes.
Exactly.
So if the RBI is locking down the macro environment, holding the submarine steady at a safe depth, how are they adjusting the actual microplumbing of the banks to handle this pressure?
Because they definitely aren't just sitting idle.
No, the MCIR clearly shows they are aggressively rewriting the regulatory rulebook. Which brings us to the granular banking regulations in Section 2.
Yes, and specifically, the way banks calculate their core strength, the CRER.
Okay, let's get into the heavy technical mechanics here. CRR stands for Capital to Risk-Weighted Assets Ratio.
It is the absolute bedrock metric of bank solvency.
And the MCIR details a major, highly technical review of the guidelines for how commercial banks are permitted to include their quarterly net profits in this CRR computation.
Right. Let's build a hypothetical scenario here to make this tangible for the exam.
Okay, I love a good hypothetical. Say I'm the CEO of a mid-sized commercial bank. We've had a solid quarter. We booked 100 crores in net profit.
Great quarter.
Thanks. Under the old rules, I couldn't just automatically take that 100 crores and add it to my Tier 1 capital buffer to improve my CR. There was a massive mathematical catch.
Right, the infamous 25% deviation rule.
Yeah, explain that.
Under the previous extant guidelines, you could only include those quarterly net profits if the incremental provisions you made for non-performing assets NPAs at the end of any of the 4 quarters of the previous financial year had not deviated by more than 25% from the average of those 4 quarters.
Which is an incredibly blunt, almost punitive mathematical hurdle. Let's trace the math on my 100 crore profit.
Okay, let's see.
Suppose my bank usually provisions about 20 crores a quarter for bad loans. That's my average. But in Q4 of last year, we decided to be incredibly conservative, maybe clean up the balance sheet a bit, and we provisioned 30 crores.
Okay, so that 30 crores is a 50% deviation from your 20 crore average.
Exactly. And under the old rule, because I was mathematically conservative and exceeded that 25% deviation threshold, I'm suddenly penalized.
Yep. You're not allowed to count your current 100 crore quarterly profit towards your capital adequacy.
That is exactly the friction the old rule created. It was originally designed decades ago as a safeguard.
Right. The regulator's fear was that a bank might under-provision for bad loans in 1 quarter, artificially inflate their profits for that quarter, and then use that phantom profit to make their capital buffers look stronger than they really were.
The 25% rule was a crude way to force consistency in provisioning.
It was.
But doesn't removing this constraint now just invite that exact kind of manipulation back into the system? I mean, if you drop the 25% rule, what's stopping a bank from gaming their quarterly profits?
This is where the broader context of banking supervision comes into play. The RBI is dispensing with this condition because it is obsolete. It's just a redundant checklist item now.
How so?
Because the overarching foundational frameworks governing how banks classify assets and provision for them have become exponentially more robust, strict, and data-driven. The RBI no longer needs a crude 25% deviation check on quarterly profits because they are directly policing the underlying asset quality through real-time supervisory data and strict mark-to-market norms.
So they are trusting the broader framework and removing a micromanaging mathematical hurdle that was actually punishing banks for conservative, lumpy provisioning.
Exactly. It's a shift from compliance by calculator to compliance by principle.
I like that phrase. And this theme of tearing down redundant regulatory structures leads us directly into one of the most critical, exam-heavy updates in the entire document.
The demise of the Investment Fluctuation Reserve, the IFR.
Yes. Let's talk about the IFR. It's a classic regulatory artifact.
It really is. Historically, banks were mandated to maintain the Investment Fluctuation Reserve as an additional specific capital buffer.
And its sole purpose was to protect the bank's balance sheet against depreciation in the value of their investment portfolios.
Specifically, they're held for trading and available for sale, government bonds and corporate securities.
Right. So if interest rates went up, the value of those older, lower-yielding bonds went down, and the IFR was there to absorb that paper loss.
Think of it like this. Imagine a commercial bank is a deep-sea diver. They are already wearing a highly advanced, pressure-resistant, reinforced diving suit.
Okay.
That modern suit represents the current Basel capital charges for market risk and the incredibly strict mark-to-market, or MTM valuation norms that force banks to recognize portfolio losses in real time.
Right.
The IFR, in this analogy, is the RBI forcing the diver to also wear a bulky, obsolete life jacket over the high-tech suit.
It's redundant. And worse, it's restrictive. It ties up capital that the bank could otherwise use to lend to the productive sectors of the economy.
Exactly. The RBI evaluated the landscape and concluded that commercial banks are already maintaining specific capital charges for market risk.
They are already following heavily revised, stringent norms on the classification and valuation of their investment portfolios based on MTM requirements.
Right. Given these overlapping prudential safeguards, keeping the IFR requirement was tying up liquidity for literally no added systemic benefit.
So the proposal in the MCIR is to completely dispense with the IFR requirement. But, and this is where you need to have your highlighters ready, the exam will test you on the specific applicability of this dispensation.
Yes, it is not a blanket rule for the entire financial system.
This is a key exam takeaway. You must memorize the entities. The dispensation of the IFR applies to commercial banks and local area banks.
Right.
However, it explicitly and specifically excludes small finance banks, or SFBs, payment banks, and regional rural banks, or RRBs.
Wait, why the exclusion? Why do regional rural banks still have to wear the bulky life jacket?
It comes down to institutional maturity and the sophistication of their internal risk management systems.
Oh, that makes sense.
Massive commercial banks have armies of quants and highly advanced treasury management systems to manage market risk dynamically.
But regional rural banks and small finance banks generally have simpler structures, more concentrated portfolios, and less sophisticated hedging capabilities.
Exactly. The RBI is revising the guidelines for these entities separately, but for now, they don't get to take off the life jacket.
The exam will definitely try to trick you by asking if the IFR is abolished for small finance banks. The answer is no. Commercial banks and local area banks only.
Right, that makes perfect sense. It's risk-weighted deregulation, and we are seeing this exact same philosophy applied not just to capital buffers, but to the actual physical boardrooms of these banks.
Yes, the MCIR outlines a comprehensive review of the matters placed before the boards of banks. Let's look at the historical context here.
Okay, let's do it.
Over the years, the RBI, in its pursuit of extreme prudence, had mandated a continuously growing checklist of specific policies, operational reviews, and administrative matters that had to be physically placed before a bank's board of directors.
It was meant to ensure oversight, but in reality, it just turned board meetings into grueling bureaucratic compliance exercises.
Exactly. You had highly paid, incredibly experienced strategic directors sitting in a room for 8 hours just rubber stamping operational reports from middle management.
Just because a circular from 2012 said the board had to review it.
Right. It diluted the core function of the board. So, in an endeavor to enable boards to utilize their time effectively, the RBI is issuing draft directions to brutally rationalize these instructions.
The explicit goal is to facilitate a more focused, qualitative engagement on high-level strategy and robust risk governance.
The RBI wants the board discussing the macroeconomic storm, technological disruption, and long-term capital planning.
Not checking off a 300-item compliance list.
Exactly.
And what's fascinating is that the RBI isn't just applying this rationalization to the banks. They are applying it to their own internal supervisory architecture.
Oh, this is a crucial numbers game for the exam. You have to remember the context of the historic 2025 regulatory cleanup.
Right. In 2025, the RBI undertook a monumental consolidation exercise regarding regulatory instructions.
They took more than 9,000 disparate, overlapping regulatory circulars and guidelines that had been issued over decades, and they meticulously condensed them into just 238 function-wise master directions.
It was a massive simplification of the regulatory code.
It was. Now, fast forward to the April 2026 MCIR. They are announcing the exact same methodology, but applied to their supervisory instructions.
The MCIR states that drafts of 64 master directions, which consolidate all extant supervisory instructions across up to 9 functional areas, are being published for public comment.
So burn these numbers into your memory for the exam. 9,000 regulatory circulars became 238 master directions in 2025. In 2026, the supervisory side is being condensed into 64 master directions across 9 functional areas.
It is about making the rulebook legible, searchable, and logical. So we've cleaned up the commercial banks, axed the IFR, streamlined the boardrooms, and condensed the master directions.
But the financial ecosystem is much wider than just traditional commercial banks.
Which brings us to a massive sector of the Indian economy, the non-banking financial companies, or NBFCs, and how the RBI is treating them.
On April 15, 2026, the RBI issued the NBFC Branch Authorization Amendment Directions. This is a major shift in operational philosophy.
The core argument driving this amendment is providing operational flexibility and facilitating the ease of doing business for NBFCs, which, importantly for your exam, explicitly includes housing finance companies, or HFCs.
Think about how an NBFC historically expanded. It operated almost like a rigid, tightly controlled franchise model.
Yeah.
If a housing finance company wanted to open a new branch in a rapidly growing Tier 3 city, they had to navigate a heavy, highly prescriptive, prior approval regulatory process. It was slow and cumbersome.
What the RBI is doing with these amendments is allowing NBFCs to shift much closer to a flexible pop-up model.
The NBFCs now have the regulatory freedom to expand, rationalize, or relocate their physical branch networks much more dynamically to capture shifting market opportunities.
However, the RBI isn't just letting them run wild, right?
No, they are swapping out upfront micromanagement for stringent macro supervision. The NBFCs have this flexibility, but they are subject to strict, overarching reporting requirements and post facto audits to ensure they are maintaining compliance.
It's a trade-off. We won't micromanage your branch openings, but your core risk reporting better be absolutely flawless.
Flawless. And speaking of flawless risk reporting, that brings us to the most critical set of directions issued in this entire MCIR.
Arguably the most important acronym you will study for this exam, IRACP.
Issued on April 27, 2026. IRACP stands for Income Recognition, Asset Classification, and Provisioning.
This framework is the absolute structural bedrock of banking transparency and stability. Let's really unpack this because you cannot understand Indian banking without understanding IRACP.
Let's trace the mechanics of a loan going bad under this framework.
Okay. Suppose a bank lends ₹1,000,000 to a corporate client. As long as the client is paying their monthly EMIs on time, the bank recognizes the interest as income and the asset is classified as standard.
But what happens when the client stops paying? The IRACP directions dictate a rigid timeline.
Once a payment is overdue by 90 days, the loan can no longer be classified as a standard asset.
Right, it must be downgraded and classified as a non-performing asset, an NPA. Specifically, it becomes a substandard asset.
And at this exact moment, two critical things happen under IRACP. First, the bank must immediately stop recognizing the unpaid interest as income.
They cannot artificially inflate their revenue with money they haven't actually collected.
Exactly. Second, they must take a specific percentage of their own capital and lock it away as a provision against this substandard asset.
And the clock keeps ticking. If that loan remains substandard for a specific period, typically 12 months, it gets downgraded again to a doubtful asset.
Which requires an even higher percentage of provisioning, eating further into the bank's capital.
Finally, if auditors determine the loan is entirely unrecoverable, it becomes a loss asset, requiring 100% provisioning. The entire ₹1,000,000 must be written off against the bank's capital.
The RBI had issued draft directions for a massive overhaul of this IRACP framework back in October 2025.
They digested an enormous amount of stakeholder feedback from the banking sector. And now, on April 27, 2026, they issued the final binding directions.
The sheer scale and complexity of this overhaul are staggering. To implement the final IRACP framework, the RBI concurrently had to issue 13 separate amendment directions and one repeal direction to clean up conflicting older circulars.
13 amendment directions just to implement one framework. That highlights how deeply IRACP touches every single accounting system inside a bank.
And remember our earlier discussion about removing the 25% deviation rule for quarterly profits? This IRACP overhaul is the exact reason they could do that.
Right. When your foundational rules for recognizing bad loans and provisioning for them are this rigorously defined and universally applied, you don't need clunky mathematical hacks to prevent manipulation.
The bedrock itself is secure, and the RBI is not just securing the domestic bedrock, they are forcefully aligning it with global tectonic plates.
Yes. Also, on April 27, 2026, the RBI issued final directions on the implementation of Basel III, specifically regarding the capital charge for credit risk under the standardized approach.
Let's lock down the exam dates first, because examiners love testing the gap between issuance and implementation.
Oh, they do.
The final directions for this Basel III framework were issued on April 27, 2026, but they do not become effective immediately. The effective date is exactly 1 year later, on April 1st, 2027.
Issuance in 26, effective in 27. Do not mix those up.
Now let's explore the why. Why is the RBI pushing Indian banks to adopt this amended standardized approach under Basel III?
The primary objective is international convergence. They are overhauling the existing framework to enhance its robustness, dramatically increase its granularity, and make it far more risk-sensitive.
All while ensuring absolute alignment with the international standards set by the Basel Committee on Banking Supervision.
Okay, let me play devil's advocate here.
Yep.
Because if I'm an analyst focusing on the domestic market, I have a major pushback.
Let's hear.
The phrase is the standardized approach. Indian commercial banks operate in a highly unique environment. They deal with massive priority sector lending mandates, complex agricultural cycles, and unique MSME structures.
Right.
Isn't importing a standardized approach from a committee in Switzerland essentially forcing a one-size-fits-all global solution onto a deeply nuanced local market? Doesn't it risk ignoring the realities of Indian credit?
That is a highly sophisticated critique, but it fundamentally misinterprets what standardized means in the context of Basel III.
Okay, correct me.
Standardized does not mean forcing every bank to adopt the exact same domestic business model or lend to the exact same types of clients. It means enforcing a globally recognized, standardized methodology for measuring and reporting the risk of whatever unique portfolio you hold.
Ah, so it's about establishing a universal language of risk.
Exactly. Think of it like accounting standards. You want an Indian bank to speak the exact same risk language as a bank in London, Tokyo, or New York.
Right, right. By increasing the granularity of the risk weights under this new framework, an Indian bank can actually reflect the nuances of its specific loan book much more accurately than under the older, broader risk buckets.
And the strategic benefit is massive. When an Indian bank operates internationally, or when it tries to raise capital from global investors, full compliance with the Basel III standardized approach provides foreign counterparties with a completely transparent, universally understood assessment of the bank's credit risk.
It lowers the cost of borrowing globally and integrates Indian finance seamlessly into the global architecture.
That clarifies it perfectly. It's not a standardized business model. It's a standardized yardstick for measuring risk, taking effect on April 1st, 2027.
So let's pull back for a second and synthesize what we've seen so far.
Good idea. The RBI is holding the macro interest rate steady. They've aggressively cleaned up the micro regulations, axing the IFR, tweaking CRR, giving NBFCs branch flexibility, overhauling the IRACP bedrock, and aligning with global Basel III standards.
Here's where the narrative of this MCIR gets incredibly compelling. None of these actions are isolated tactical reaction.
No, they are deeply coordinated moves dictated by a much larger, overarching strategic blueprint.
Which brings us to Section 3 of the MCIR, and Part 4 of our deep dive. The Master Plan, Utkarsh 2029.
To understand the RBI, you have to understand that they do not simply manage crises month to month. They govern via comprehensive, medium-term strategy frameworks.
Context is key here for the exam. The RBI had previously been executing a strategic framework known as Utkarsh 2.0, which covered the periods from 2023 to 2025. It laid the groundwork for post-pandemic normalization.
Now, building seamlessly upon the progress of Utkarsh 2.0, the RBI has finalized and launched its new medium-term strategy framework titled Utkarsh 2029.
This framework covers the three-year period from April 2026 to March 2029. This is the central bank publicly declaring its operational North Star.
This document is not just a glossy brochure of aspirations. It physically dictates how the RBI allocates its internal budgets, prioritizes its regulatory pipeline, and deploys its human capital.
Crucially, the implementation and progress of Utkarsh 2029 are subject to rigorous periodic monitoring by a dedicated subcommittee of the RBI Central Board.
For your exam, you absolutely, non-negotiably must memorize the structural foundation of Utkarsh 2029. It is built upon 6 core strategy pillars, all guided by a central vision statement.
We are going to walk through these 6 pillars, not just as a list, but by connecting them to the actual regulatory actions we are discussing today.
Let's start with Pillar 1, robust regulations.
We just spent 20 minutes proving this pillar exists. The massive 13th Amendment overhaul of IRACP, the implementation of the Basel III standardized approach, the consolidation of 64 supervisory master directions.
That isn't random. That is the explicit execution of Pillar 1, creating a regulatory framework that is globally aligned and structurally unbreakable.
Precisely. Pillar 2, customer centricity and inclusive finance.
This pillar acknowledges that a stable banking system is useless if it doesn't serve the actual population.
We are going to see this pillar in aggressive action when we move to Section V and discuss the Treaty S platform for small businesses and the massive upskilling of grassroots cooperative banks. It's about pushing financial access down to the final mile.
Pillar 3, competitive markets.
This is a fascinating one. The RBI explicitly states they do not want a financial ecosystem dominated by a few lazy, monopolistic behemoths.
Right. They want deep, liquid, fiercely competitive markets because competition ensures efficient price discovery and optimal transmission of their monetary policy.
This is the exact philosophy driving the expansion of the term money market, which we will dissect in just a moment.
Pillar 4, effective technology.
The digital backbone. This covers the constant upgrading of payment systems like UPI, the rollout of the central bank digital currency, the CBDC, and the integration of advanced regulatory technology RegTech to monitor systemic risks in real time.
Pillar 5, future-ready organization.
This is the RBI looking inward. They are acknowledging that regulating a 2026 financial ecosystem dominated by algorithmic trading, AI credit models, and decentralized finance, requires a radically different skill set than regulating banking in 2010.
This pillar is about upskilling the RBI's own workforce, breaking down internal silos, and building a nimble, tech-fluent central bank.
I'm finally Pillar 6, Global India.
This is the outward-facing ambition. It encompasses efforts to internationalize the rupee, allowing it to be used more widely for cross-border trade settlement.
It also involves enhancing the global footprint of Indian financial institutions and actively participating in global standard-setting bodies like the Basel Committee.
So to reiterate for your notes, the 6 pillars of Utkarsh 2029 spanning April 2026 to March 2029 are robust regulations, customer centricity and inclusive finance, competitive markets, effective technology, future-ready organization, and global India.
Every single circular, draft direction, and policy rate change you will study over the next 3 years maps directly back to one of these 6 pillars.
Let's pull the thread on Pillar 3, competitive markets. The MCIR immediately moves from stating the strategic goal to detailing exactly how they are aggressively opening up specific markets right now.
That transitions us beautifully into Section 4, analyzing financial markets. The first major market structural change detailed here is the development of the term money market.
To grasp the significance of this, we must clearly define the market's historical constraints. Historically, the term money market, where funds are borrowed and lent for periods ranging from 15 days to 1 year, was practically a walled garden.
It was a highly exclusive club where participation was heavily restricted, limited almost entirely to major commercial banks and a select group of standalone primary dealers, and even they operated with strict prudential borrowing limits.
The RBI looked at this walled garden and realized it was stifling the creation of a deep, liquid yield curve.
So the policy change announced in the MCIR drastically alters the architecture in 2 ways. First, they are breaking down the walls and expanding the participant base to include a wide array of non-bank entities.
We are talking about all India financial institutions, NBFCs, housing finance companies, and even large corporates.
Second, for those standalone primary dealers who are already in the market, the RBI is significantly enhancing their borrowing limits.
Let's walk through a concrete scenario to show why this matters. Say I run a massive, highly rated NBFC specializing in infrastructure financing. I need to raise 500 crores for 3 months to manage a short-term liquidity mismatch.
Okay, historically, you couldn't access the term money market directly. You had to rely on issuing commercial paper, which is heavily dependent on mutual fund appetite.
Or I had to go beg a commercial bank for a short-term working capital loan, often at a premium rate because the bank knows I have limited options.
Exactly. But now, with the RBI opening up the term money market, your NBFC can enter the centralized liquid arena directly. You can borrow that 500 crores for 3 months by interacting with a much broader pool of lenders, including banks that have excess short-term cash.
It's like opening up an exclusive, VIP-only financial toll road to commercial freight. Suddenly, the NBFCs and corporates have a highly efficient alternative funding avenue.
But the RBI isn't just doing this to be nice to NBFCs. There is a deeply selfish macroeconomic motive here, isn't there?
Absolutely. The central bank's primary motivation is enhancing the transmission of monetary policy. Let's connect the dots back to Section 1.
The MPC sets the repo rate at 5.25%. That is an overnight rate. It's the cost of money for literally 1 day.
But the RBI needs that 5.25% signal to dictate the interest rate on a 3-month corporate loan or a 5-year infrastructure bond. How does a deep-term money market facilitate that?
By creating a continuous, liquid chain of pricing. If the term money market is deep and active, with diverse participants trading continuously, it creates a highly accurate, market-driven yield curve.
The overnight repo rate smoothly influences the 14-day rate, which logically prices the 3-month rate, and so on.
Right. When you allow NBFCs and corporates to borrow directly in this market, the cost of their short-term debt reflects the RBI's policy rate almost instantly.
By opening the market, the RBI ensures that when they tweak the dials on the submarine's control panel, the entire economy feels the shift rapidly and proportionately. It bridges the gap between macro policy and micro pricing.
That is a phenomenal mechanical breakdown. The broader the participation, the cleaner the price discovery, the faster the monetary transmission.
Now, while the RBI is eagerly expanding participation in the domestic term money market, they are simultaneously expanding their surveillance perimeter in the foreign exchange market.
This brings us to a highly specific regulatory directive issued on April 27, 2026, the reporting instructions for authorized dealer category I banks.
The RBI had circulated draft directions on this concept back in February, and the final rules are now in effect.
The mandate is incredibly precise. Authorized dealer, or AD, Category I banks, which are essentially the major commercial banks authorized to handle heavy foreign exchange transactions, are now legally required to report a specific subset of data to the central bank.
They must report all foreign exchange derivative transactions involving the Indian rupee that are undertaken by their related parties globally.
And this data must be piped directly into the trade repository of the Clearing Corporation of India Limited, or CCIL.
Let's visualize what this actually means on the ground. Say you have a massive Indian conglomerate that owns an AD Category I bank in Mumbai, but they also have a related corporate entity operating out of London or Singapore.
That related entity in London might decide to execute massive speculative trades or complex hedges using non-deliverable forwards against the Indian rupee in the offshore market.
Historically, because the trade was executed by a separate legal entity in a foreign jurisdiction, it sat outside the immediate, real-time purview of the RBI in Mumbai. It was a blind spot.
And in global finance, blind spots create systemic vulnerability. What the RBI is doing with this directive is installing a global radar system.
They are telling the AD Category Bank app, we don't care if your related party executed the INR derivative trade in London, Dubai, or Singapore. If it involves the rupee and it involves your corporate family, you must capture that data and report it to the CCIL trade repository in Mumbai immediately.
It's a massive data aggregation exercise. Why does the RBI need this visibility so badly?
Because offshore derivative markets can exert immense pressure on the onshore currency valuation.
If a coordinated group of related entities is building up a massive, highly leveraged short position against the rupee in London, the RBI needs to see that accumulation of risk in real time on their CCIL dashboard.
It allows them to understand the true aggregated global demand and supply dynamics for the rupee, enabling them to intervene in the onshore forex markets much more effectively to maintain external sector stability.
It's about erasing blind spots and managing global risk proactively.
So we have covered an immense amount of high-level architecture. We've anchored the macro policy defense. We've dissected the highly complex changes to commercial bank capital rules and IRACP. We've outlined the multi-year Utkarsh 2029 master plan. And we've analyzed the strategic deepening of the term money and forex markets.
But a central bank cannot just focus on the titans of finance. They have to manage the actual grassroots plumbing of the economy.
How does the money flow for the tiny auto parts supplier or the local neighborhood cooperative? This brings us to our final section, Section V, empowering the base, MSMEs, co-ops, and digital payments.
Let's begin with a massive pain point in the Indian economy: working capital for micro, small, and medium enterprises, the MSMEs. The MCIR details a significant policy shift regarding the TRED-S platform.
TRED-S, Trade Receivables Discounting System. If you are taking the exam, you need to know the historical evolution of this platform. The initial guidelines for TRED-S were rolled out in 2014, specifically to solve the chronic issue of delayed payments to MSMEs.
The framework was subsequently updated in 2018, and its scope was expanded significantly in 2023 with the authorization for insurance companies to participate.
Let's walk through the exact day-by-day mechanics of how TRED-S operates, because it illuminates why the RBI's new policy change is so clever.
Okay, imagine an MSME, let's say a small factory in Pune manufacturing, specialized ball bearings. They secure a massive contract to supply these bearings to a giant corporate automaker like Tata Motors.
The MSME delivers the goods perfectly, but the corporate automaker operates on standard 90-day payment terms. They say, great job, here is an approved invoice, we will pay you in 3 months.
And this is where the MSME gets crushed. They have to pay their workers this Friday. They have to buy raw steel next week. They cannot wait 90 days for cash.
They are facing a severe liquidity crunch despite having a perfectly healthy, guaranteed receivable from a blue-chip company.
This is exactly the crisis TRED-S was built to solve. The MSME takes that approved 90-day invoice and uploads it onto the digital TRED-S platform.
Now, a financier on the platform, typically a major commercial bank or a factoring company, looks at the invoice. They see that Tata Motors is legally obligated to pay it.
The bank says, we will buy this invoice from you right now. The invoice is for 100 rupees. We will give you 98 rupees in cash today.
The MSME gets immediate liquidity to run their factory, taking a tiny haircut. And in 90 days, Tata Motors pays the full 100 rupees directly to the bank, and the bank pockets the 2 rupee difference as their profit.
If a brilliant systemic solution. It's an invoice discounting factory. But the platform had a friction point. Which brings us to the policy change announced in this April 2026 MCIR.
To promote ease of doing business and aggressively encourage more MSMEs to actually use the platform, the RBI is proposing to entirely dispense with the requirement of due diligence, specifically for the MSMEs, while onboarding them onto the TredeS platforms.
Wait, let's pause right here and apply some critical scrutiny. We're talking about a financial system that is globally obsessed with KYC, Know Your Customer, and anti-money laundering protocols.
Every bank account requires immense documentation. Isn't intentionally removing the due diligence and KYC requirements for an entity joining a financial transaction platform an absolutely massive, gaping fraud risk? How can the RBI justify this?
This is the exact analytical pivot the exam will test you on. To understand why this isn't a systemic hazard, you have to look ruthlessly at where the actual financial risk resides in a TredeS transaction. Who is bearing the risk of default?
Well, the bank that bought the invoice is taking the risk, and they're relying entirely on the massive corporate buyer Tata Motors in our example to actually pay up in 90 days.
Precisely. And both of those entities, the giant corporate buyers and the financing banks, are already massively regulated, deeply vetted entities. They have undergone intense, exhaustive due diligence to even exist in the formal financial system.
Right. The MSME, in the context of this specific transaction, is not applying for a loan based on their own creditworthiness. They are simply selling an asset, a verified, approved receivable from a blue-chip buyer.
Ah, I see. Because the corporate buyer has already digitally verified and approved the invoice on the platform, confirming they received the goods and owe the money, the identity or credit history of the MSME supplier is actually irrelevant to the financial risk of the transaction.
The bank is underwriting Tata Motors, not the small factory in Pune.
Exactly. The RBI looked at the mechanics and realized that forcing heavy, redundant KYC and due diligence onto the tiny MSME was just creating administrative friction that was preventing them from accessing their own capital.
By removing the specific onboarding friction, the RBI is making a highly surgical, exceptionally low-risk deregulation. It drastically accelerates the speed at which a small business can get cash, resolving their critical liquidity crunch without fundamentally compromising the security of the TredeS platform.
It is a masterclass in targeted, risk-weighted deregulation.
That is a phenomenal insight. They aren't ignoring risk, they are just correctly assigning it.
And while they are removing administrative burdens for MSMEs, they are simultaneously injecting a massive amount of structural support into another vital grassroots sector, the urban cooperative banks, or UCBs.
This brings us to a major exam highlight. Mission SACTION. You need to memorize the acronym, the launch date, and the target demographic.
Mission SACTION was officially launched on April 28, 2026. SACTION stands for Sakari Bank Kshamtha Nirman. It is a mission-mode, sector-wide, pan-India capacity-building and training initiative.
The target audience is specifically the UCB sector, and the sheer scale is staggering. The RBI aims to train approximately 1.40 lakh participants.
140,000 individuals. That is a logistical mountain. Who exactly are they training, and why the intense focus on cooperative banks?
The training curriculum comprehensively covers board members, senior management, the operational heads of risk, compliance, and audit functions, and critically, the IT employees of these banks.
To ensure actual comprehension and adoption, the content delivery will be conducted in regional languages to the maximum extent feasible, and it has been designed in deep consultation with the umbrella organization of UCBs as well as national and state cooperative federations.
To understand the why behind Mission SACTION, you have to understand the historical vulnerability of the cooperative banking sector in India.
These banks are the absolute grassroots of Indian finance. They operate in local neighborhoods, serving micro-communities and retail clients that major commercial banks simply ignore because the ticket sizes are too small.
They are vital for financial inclusion. But historically, because of their localized nature, they have frequently suffered from severe structural deficiencies.
We have seen numerous local systemic failures of UCBs over the past decade, and the root causes are almost always identical. A lack of professional corporate governance at the board level, severely outdated IT infrastructure that is vulnerable to cyber attacks or internal fraud, and highly unsophisticated risk management protocols that fail to identify concentrating loan portfolios.
A local UCB board might consist of well-meaning community leaders, but they don't necessarily know how to audit an algorithmic credit risk model or implement an IT disaster recovery plan.
Precisely. Mission SACTION is the RBI, recognizing that you cannot just regulate these entities into stability, you have to physically build their capacity to be stable. It's a massive, standardized upskilling injection.
The RBI is proactively attempting to fundamentally enhance managerial capabilities, embed a modern compliance culture, and drastically strengthen the institutional resilience of 140,000 key personnel.
It's about ensuring systemic stability from the ground up, preventing the failures before they ever materialize.
It is grassroots empowerment through aggressive education. Finally, we must touch on the digital plumbing that binds this entire ecosystem together: digital payments.
The MCIR highlights two specific regulatory movements here. First, on April 21, 2026, the RBI issued consolidated directions regarding the digital payments e-mandate framework.
This is the critical infrastructure that governs automated recurring payments. Everything from your monthly Netflix subscription to automated mutual fund SIPs.
The consolidated directions incorporate extensive stakeholder feedback to ensure the framework balances user convenience with stringent security and notification protocols.
And second, just a day later, on April 22, 2026, they issued a draft master direction covering prepaid payment instruments, or PPIs. Think digital wallets, smart cards, and transit passes.
The objective here is to develop a highly conducive, modernized framework that supports the long-term exponential growth of PPIs while mandating enhanced security architectures to protect consumer funds.
And here's a highly specific, easily testable detail for the exam. The RBI has opened this draft master direction up for public comments and feedback.
They're collecting this feedback via a highly specific portal known as the Connect to Regulate portal. The deadline for submitting comments is May 22, 2026.
Memorize that portal name: Connect to Regulate. It's exactly the kind of obscure, highly specific, factual detail that examiners use to differentiate a candidate who casually skimmed a summary from a candidate who actually studied the primary document.
And that comprehensive breakdown brings us to the conclusion of the technical material in sections I through V of the April 2026 MCIR.
Let's take a deep breath and synthesize this incredible journey. We started high up on the bridge of our metaphorical submarine, analyzing the RBI's macro defense strategy.
We saw the MPC unanimously hold a rigid, neutral repo rate at 5.25%, carefully navigating a swirling geopolitical storm of West Asian energy volatility and domestic El Niño food inflation risks.
We saw that while growth is slightly softening, core inflation is contained, justifying the defensive wait-and-watch posture.
We then descended into the engine room, meticulously detailing the aggressive micro-regulatory cleanup. We saw the RBI structurally tear down redundant buffers by axing the IFR for commercial banks.
We saw them eliminate frictional mathematics by dropping the 25% deviation rule for CRAR computation. And we examined the absolute overhaul of the banking bedrock through the 13 IRACP amendment directions and the mandate to adopt the globally aligned Basel III standardized approach for credit risk by April 1st, 2027.
We looked ahead at the architectural blueprints with Utkarsh 2029, memorizing the 6 strategic pillars that will guide the RBI through March 2029.
We watched the RBI actively expand the financial highways, allowing NBFCs onto the term money market to enhance monetary transmission, and we saw them install a global radar system via CCL reporting for offshore rupee derivatives to eliminate systemic blind spot.
And finally, we analyzed the grassroots plumbing. We saw the brilliantly targeted deregulation of dropping MSME due diligence on the TredeS platform to solve liquidity crunches, and we witnessed the massive logistical undertaking of Mission Saksham, aiming to upskill 1.4 lakh personnel in the cooperative banking sector.
As your peers and fellow analysts, we want to emphasize one final point. Mastering these mechanics, tracing the exact flow of a substandard asset under IRACP, knowing why RRBs still need the IFR, understanding how a deep-term money market transmits a repo rate cut, this level of granular, interconnected understanding is what will make you absolutely unstoppable on exam day.
You don't just know the facts, you know the underlying logic of the entire financial system. Before we officially sign off, I want to leave you with one final, deeply provocative concept to mull over before you walk into that exam room.
Okay, lay it on us.
We have spent this entire hour analyzing how the RBI is systematically identifying and removing operational friction. They axe the IFR, they drop the TredeS due diligence, they slash 9,000 circulars down to a handful of master directions.
They rationalize the mandated reviews for bank boards, telling them to stop acting like compliance checkers and start acting like strategists.
The overarching, undeniable theme of this MCIR is a massive paradigm shift. The RBI is moving away from a rigid, micromanaging, rule-based checklist approach and moving aggressively toward a principle-based, risk-weighted oversight model. They are granting institutions the operational freedom to run their businesses.
They are trusting the reinforced diving suit and taking off the bulky life jackets.
Exactly. But here is the fundamental structural question for you to ponder. As the central regulator intentionally steps back from micromanagement and shifts toward this principle-based model, where does the ultimate burden of systemic stability actually land?
It doesn't disappear.
Does that immense burden now fall squarely, and perhaps terrifyingly, heavily onto the shoulders of the internal audit committees, the chief risk officers, and the newly liberated board of directors of these institutions?
If a catastrophic bank failure happens in 2028, it likely won't be because a specific regulatory box wasn't checked. It will be because the institution's own internal principles and risk models fundamentally failed.
The training wheels are coming off, the freedom to operate is expanding, but the internal accountability is becoming absolute.
The burden of stability is shifting from the regulator to the regulated. That is a phenomenal analytical lens through which to view every single policy change we've discussed today. Keep that thought, keep those mechanics, and keep all those key exam dates front and center in your mind. We wish you the absolute best of luck on your upcoming professional examination. You have the knowledge. Now go crush it.